Greetings from our team at Robare Jones Wealth Management. My name is Jack Jones, the managing partner, with our August monthly market update. Congratulations to our U.S. Olympians who brought home 113 total medals, 25 more than second place China, and also inched out China for gold, 39 versus 38, to capture the gold medal winner, as well as total medal winners for the U.S. athletes. So congratulations to them. We're excited to announce an in-person client event on December 1st. That's on a Wednesday over the lunch hour. We have missed having gatherings in person, and we are so looking forward to greeting you there for a client appreciation event, a little bit of market update, and introducing you to new team members, and enjoying the fellowship and celebrating the season with you on December the 1st. So we're going to talk about the Fed today and their dual mandate. Now, before you go to sleep, these two items are very noteworthy today, both inflation and employment or unemployment. So we're going to kind of talk about those. Again, the Fed has a dual mandate of price stability and maximum employment. We're going to unpack those a bit more. So we're getting mixed signals from on both fronts, both inflation and employment. So we're going to unpack that a little bit. So price stability is the first mandate of the Fed, and the Fed targets a 2% inflation rate. Inflation is the elephant in the room, largely because this 5.4 number is a 13-year high on inflation. Now, what's interesting in terms of the mixed signal is the bond market measured by the 10-year is at 1.4. So this disconnect, 5.4 on inflation and 1.4 on the 10-year, is as high as it's been since 1980. And if you recall, inflation was very high then. So that's an important characteristic to watch. These things don't normally happen at that level of difference. So very, very much something to pay attention to. So inflation index impacts everybody. It's everything from the strength of the economy to adjusting Social Security payments. The reason inflation is relevant today is because, again, it's running at a 13-year high. Now, part of the reason the Fed's letting this go a bit is because compared to how we started the decade and the last decade, inflation is running below target. So they're letting it go a bit. Now, they're watching this carefully, as are we. At some point, they will likely respond in terms of reduced asset purchases and or increases in interest rates. So it's something we're paying attention to. A lot of reason for inflation rising. We've got the Fed spending a lot of money, pent-up demand, production costs. So a lot of things are driving to the inflation where we are today, which raises the question, is this short or long term? The answer may be yes, some of both. There is some supply demand disruption, but there's also wage gains. So you may answer the question, yes, there's some parts of inflation that are short term, but there also may be long-term impacts. Part of the issue with inflation is how it's calculated. We've talked about this before, but the housing prices are up April over April, almost 15%. And yet the CPI component of home ownership measures owners' equivalent rent as opposed to home prices. So again, this is not fully reflecting how hot the housing market is in large measure. There's a 12.6% difference between average sales price and owner's equivalent rent. There's also a part of the CPI calculation that's a quality enhancement. This changed in 1998, where if you look at just example on a cable bill, for most of us, if our cable bill went from 40 to 47, that would be an 18% increase. But the way that they calculate this quality enhancement is your cost per channel didn't change by nearly as much. So it's only in the CPI calculation up 4%. Now, to the extent that inflation becomes something that's longer term, we'll focus on asset areas that tend to do well during inflation on both the stock and bond side. Commodities and energy stocks are two good examples that perform well during inflation. on the bond side of the allocation, emerging market bonds and high yield bonds. The second part of the Fed mandate is maximum employment. Now, we had a really good jobs number this past Friday, 943 jobs added, unemployment rate down to 5.4%. And yet there's over 10 million jobs available. So this mismatch between demand and supply really has been a defining characteristic of the recovery post-pandemic. We've also seen wage growth because there's a shortage of supply, that being labor. It's being paid more, so 4.6% is the average wage increase. However, if you think about that in terms of inflation at 5.4, assuming both of those things reflect both income and outgo, you're really net losing about a point in terms of purchasing power if you compare 5.4 inflation against 4.6 wage growth. So where does all of this leave us? Obviously, inflation and unemployment are two key things that we're watching, and what the Fed is going to do, what actions they're going to take. One of the results of the moment that we're still in is that there's basically nothing to be made in cash and money market accounts, and over $4 trillion still sits there. So I think one of the things we just see kind of financial markets calmly creeping up from here. Earnings expectations have been good, so that's part of the effect, but part of it as well is just that there's not really compelling places to place capital. So we still think this over 4 trillion that's sitting in money market accounts will likely move up either in the form of spending or investing in a place where there's a better risk reward trade-off. So that being said, we try to keep these brief so that you don't go to sleep, and share a couple of pieces of information with you that we're following. As always, if you have any questions at all, please do not hesitate to give us a call about how any of these things affect you personally. Until we get to see you again, hopefully at our December 1st event, we hope you all stay well and take care.